The chart says late April buying interest creates a timely reason to explain why India can decouple from headline gold quotes. Looks manageable while the physical market is getting tighter at the same time. That contradiction is the part most coverage skips, and it changes how a real stacker should read the next few weeks. By the end of this video, you'll know which pressure point matters most, why it is tightening now, and what it means if you hold 350. For lazy explanation is that this is just emotion, just a local quirk, or just a one-day dealer markup. That is too simple. A small premium can be noise. A large premium in a major buying market, right before a concentrated buying window, is usually the market telling you that the replacement cost of the next ounce is more important than the printed price of the last trade. That is the mindset shift most people miss. Spot tells you what gold traded for in a global financial venue. A physical premium tells you what someone is willing to pay to actually get metal in a specific place, in a specific time frame, with real delivery risk and real urgency attached. Here's what this means if you're stacking silver right now. Those are not the same thing, and late April is exactly when that difference can stop being academic. One way to think about it is this. The screen gives you a reference price, but the physical market sells you certainty. When conditions are easy, the gap between reference and certainty can stay small enough that most buyers ignore it. When conditions tighten, certainty becomes expensive. Immediate delivery, familiar products, and reliable restock all start carrying their own price. That is why physical stress can feel invisible until you actually try to buy. The chart looks tradable. The counter feels rationed. In a market like India, where buying culture is deep and time-sensitive windows matter, that gap can widen fast because demand is not just speculative. A lot of it is intent-based. People are buying for savings, gifting, tradition, and inventory needs, which makes the market harder to call with a few quiet sessions on the chart. The first driver is compressed buying demand. India does not buy gold in a smooth, perfectly even line every week of the year. For your physical metals position, this changes the math entirely. AR, buying clusters around moments that matter, and when late April demand starts being pulled forward, the local market can tighten fast even if the international chart still looks orderly. This is why a premium can jump before the broader market feels dramatic. You are not looking at a random surge of interest. You are looking at many different kinds of buyers stepping into the same window at the same time. Households, jewelers, gift buyers, savers, and people who have been waiting for a calendar trigger rather than a chart pattern. That concentration changes the speed of the market. Inventory that looked comfortable when viewed on paper starts looking thin once real people want immediate delivery instead of theoretical exposure. And this is where the first big contradiction appeared. What does this mean for stackers? Here's the real number. RETs. A calm global quote can fool you into thinking conditions are calm everywhere, but a local dealer is not selling you yesterday's chart. The dealer is selling you metal that has to be replaced in a tighter window. If enough buying is pulled into the second half of April, the quote you see in the morning is less important than what the dealer thinks it will cost to restock by next week. That is why premiums rise faster than many viewers expect. The physical market is forward-looking in a very practical way. It asks a brutal question. If this bar leaves the counter today, how expensive and how difficult will it be to replace before demand peaks? For a real stacker, that means waiting for a tiny dip in spot can be a trap if the local premium expands faster than the chart falls. If you follow physical metals for availability rather than just headlines, hit like here because this is exactly where paper price starts misleading people. The second driver is import tightness and replacement cost. India is a giant physical market, but that does not mean every dealer has endless inventory sitting around waiting for buyers. Physical gold has to move through wholesalers, logistics, financing, hedging, fabrication, and retail distribution. When that chain is smooth, premiums can cool. When that chain gets tighter, even by a little, the local market starts repricing immediately. The mistake people make is imagining that a bar in the showcase is cheap inventory because it was sourced earlier. In reality, many dealers think in replacement terms. They know the relevant price is not what they paid last week. It is what they will have to pay to put the next bar back on the shelf after this one is gone. If replacement is getting harder, slower, or more expensive, the premium stops being optional. Also notice how this changes dealer behavior. Before most viewers notice anything unusual, dealers do not need to post a dramatic shortage sign for the market to be tight. They can adjust more subtly. They may quote one product aggressively and another only on request. They may protect inventory in the fastest moving sizes. They may keep selling, but with less enthusiasm for locking in yesterday's margins when tomorrow's restock looks less certain. That is why the most useful physical signal is not a dramatic headline. It is often a series of small changes, a firmer premium, narrower product choice, faster quote changes, and less willingness to honor low margin pricing when the restock math is turning against the seller. Those details matter because they are exactly what a real buyer feels first. This is why a large premium can persist even without a dramatic daily spike in the global chart. The physical market is pricing landed cost, not just screen cost. Freight, financing, wholesaler margins, fabrication bottlenecks, and the simple risk of delay all matter more when buying is time sensitive. A dealer who thinks replacement metal may arrive later or cost more tomorrow will not happily sell cheap inventory into an expensive replacement market today. That dealer widens quotes, becomes more selective on product, or shifts customers toward whatever is easiest to replenish. For the stacker, this matters because product choice starts separating. A kilo bar, a 50-gram bar, a 20-gram bar, and a 1-ounce coin do not always tighten in the same way. Smaller finished products often feel the squeeze sooner because fabrication and retail inventory are thinner than wholesale bar supply. So after any discussion about imports or logistics, always bring it back to one question. Is your next ounce becoming cheaper to acquire or harder to replace once it sells? Now make that personal. A premium of $350 per ounce works out to a little over $11 per gram before you even get into local taxes and fabrication. That means a 10-gram bar can feel roughly $112 richer than the headline quote alone suggests. A 20-gram bar can feel around $225 richer. A single 1-ounce coin or bar carries the full roughly $350 gap. A 50-gram purchase can reflect more than $560 of premium pressure before the rest of the local markup stack is added. That is why people who stare only at spot can feel blindsided at the counter. They think gold was flat, but their actual buy ticket says otherwise. And if you are shopping before April 30th, tell me in the comments whether you are looking at 10 grams, 1 ounce, or 50 grams, because the size you buy changes how brutally this kind of premium hits your budget. The third driver is geographic arbitrage, and this is where the story gets bigger than one country without turning into a generic macro lecture. When India is willing to pay up for immediate metal, nearby physical channels matter. Gold does not teleport from a calm chart into a busy retail market. It moves through real hubs, real wholesalers, real financing decisions, and real delivery lanes. If the easiest immediately deliverable inventory is already committed, then metal flows toward the buyer, showing the most urgency and paying the strongest effective price. That does not always blow up the paper quote first. Sometimes the first signal is exactly what we are discussing here, a regional premium that stays elevated because the destination market values immediacy more than the screen reflects. In other words, the physical market is voting before the chart catches up. This is also why geographic price gaps are not trivia for stackers outside India. Even if you are buying somewhere else, a strong premium in a major physical market can feed into global replacement psychology. Wholesalers watch where metal is moving. Dealers watch where restocking is getting expensive. Fabricators watch which products are clearing fastest. If a big destination market is consistently bidding above the headline quote, that can influence spreads and availability elsewhere long before your local headline says there is a shortage. You may not see a dramatic move in spot, but you might see longer delivery times, fewer choices in familiar products, or a quiet shift toward higher ask prices on the exact item you wanted. That is why the smarter question is never only, where is gold trading today? The smarter question is, where is immediately available metal being pulled, and what does that do to the replacement chain? There is another reason this matters. Into a specific late April window, time pressure changes how buyers behave. If you are buying for some distant future point, you can wait out a bad quote. If you are buying into a known calendar window, patience becomes less flexible. That gives sellers more pricing power whenever supply is not perfectly loose. In other words, urgency itself becomes part of the premium. The buyer is not only paying for gold, the buyer is paying for gold now, in the desired form, without the risk of missing the window. That may sound obvious, but it is exactly why local premiums can look irrational to people who study only the global chart. The chart is pricing exposure. The physical market is pricing timing. Now, here is the part that deserves some discipline. None of this guarantees that the international gold price has to explode tomorrow. Premiums can stay hot for local reasons and then cool if fresh supply catches up, if buyers step back, or if higher local prices do the market's rationing work. So the takeaway is not blind excitement. The takeaway is that a premium like this changes the order of importance. If your goal is to own metal before April 30th, then acquisition cost, delivery timing, and product availability matter more right now than winning an argument about whether spot should already be higher. The chart may eventually respond. It may not respond on your schedule, but your dealer quote is responding now, and that is the number you actually have to live with. This is where the most common false move happens. A buyer sees international gold soften a little and assumes waiting a few sessions will automatically improve the final purchase price. But if the local premium is being driven by concentrated demand, tight replacement, and a market willing to pay for immediacy, then a small dip in spot can be completely overwhelmed by a firmer premium. You win $10 on the chart and lose $100 on the actual quote. Or you save on the headline number and discover the product you wanted has a longer wait, fewer options, or a wider spread than it had a week earlier. That is not theory. That is how physical markets ration demand before a headline breakout ever arrives. The market does not need to deny you gold. It only needs to make the exact product and timing you wanted less convenient and more expensive. So what should a real stacker watch between now and April 30th? First, watch whether the premium itself stays elevated when the paper quote goes sideways. If it does, physical stress is still present. Second, watch delivery language from dealers and wholesalers. If the conversation shifts from immediate availability to short waits, allocation, or selective product quoting, the market is telling you replacement is not easy. Third, watch product behavior, not just the generic gold headline. If smaller bars and familiar retail pieces start getting quoted more aggressively than larger wholesale forms, that usually means the retail layer is feeling the squeeze first. Those three signals together tell you much more than a single screen price ever will. If I were reducing all of this to one practical rule, it would be simple. Do not wait for the paper market to validate what the physical market has already told you. If your plan depends on specific timing, specific product, or a strict budget, get quotes early and compare the final delivered number, not just the spot number. A calm chart with a hot premium is not a contradiction once you understand how physical supply works. It is a warning that the visible price and the actionable price have separated. For stackers, that separation is usually more important than whatever headline wins social media for the day. And this is where the original question gets answered. What is really tightening underneath India's roughly $350 gold premium heading into late April? It is not one mysterious lever. It is a chain. Concentrated buying pulls demand into a shorter window. Import and distribution friction raise the replacement cost of the next ounce. Geographic arbitrage rewards immediate metal and keeps regional premiums firm even while the global chart looks more relaxed than the physical market underneath it. Once you see that chain, the premium stops looking weird and starts looking informative. It is the physical market's way of saying that the price on the screen is not the full price of access. So if you are planning a buy before April 30th, think less like a chart watcher and more like a buyer managing replacement risk. If you want one 10-gram bar, one 1-ounce coin, or a 50-gram position, ask yourself which matters more this week, saving a small move in spot or securing the exact product before premiums and availability get worse. That answer will be different for every stacker, but it should be an informed answer, not a PA now you see the full picture. That gap between paper and physical isn't random, and here's what it means for your metals. A part woe only answer. If you want follow-ups that separate paper price from physical delivery stress, subscribe here, because this is exactly the kind of setup where a calm chart can hide a tightening market. And if the premium stays firm while delivery gets less flexible into late April, that is your clearest warning that the next buying window is getting tighter, even before the headline gold quote decides to admit it. One last practical layer matters here, especially if 350 is not a trading chip to you, but a serious position. The market does not need to hand you perfect certainty for this window to matter. It only needs to change how it prices the path into late April buying interest, creates a timely reason to explain why India can decouple from headline gold quotes. That is why discipline beats prediction in a setup like this. If the move comes fast, you need to know what a real win looks like for 350. If the move stalls, you need to know whether you are looking at noise or a real failure of the catalyst chain. For a real stacker, the question is not whether the headline sounds exciting. The question is whether it changes the price, access, or replacement cost of real ounces in a way you would actually feel. The useful signal is not the first candle after late April buying interest creates a timely reason to explain why India can decouple from headline gold quotes. It is whether the market starts treating this setup as more believable a few days later,